Tandem Investment Advisors presents Tandem Talk, the quarterly financial podcast bringing you a seat at the table with Tandem's investment team.
Hello, everyone, and welcome back. This is Tandem Talk 25. My name is John Carew. As always, I'm joined by the rest of our investment team, Billy Little,
Hello, everyone.
Ben Carew,
Hey, how's it going?
and Jordan Watson.
Hey.
All right. It's been a minute since we were all together. We last convened this group in May, and we all actually went back and reviewed Tandem Talk 24 to see what pearls of wisdom we dropped. And it turns out that over the last two podcasts, we've been pretty spot on with the market and with our portfolio. We got a lot of things right. So, Jordan, you made a list of some of the things we highlighted in Tandem Talk 24 back in May. Would you mind just sort of reviewing that list, and we'll start from there?
Yeah, of course. So certainly a lot has happened in the last 2.5 months since we recorded. So the last podcast was released at the end of May. Since then, you've seen the momentum trade roll over. We talked about how extended that trade had really become off of the March lows. The market.
And just to be clear, momentum is simply what has been working continues to work until
That's
it doesn't.
right.
Just
That's right.
wanted to
So
qualify.
at the time it was, and it still is to some degree, semiconductors, chip stocks, the AI build out. So the market topped out a couple of days after our podcast was released. I actually think it was the Tuesday after Memorial Day, which we jokingly
We called.
mentioned, we called. Um, And yeah, so momentum has sort of caught down where our space, or our factor, if you will, in our low beta suite has sort of caught up a bit, right? It still remains historically undervalued relative to itself, to the market. But that trade in and of itself that we had talked about potentially happening more or less happened. A lot has happened since we last recorded. So we mentioned the rollover momentum. You had South Korea, the Kospi sort of blow up. Situational awareness, which we'll get into, a tech and AI focused hedge fund also blew up. You had the SpaceX IPO. We talked about IPOs sort of at the end of the last podcast. That came to market. We have a new Fed chair, Kevin Warsh. He gave his first meeting in June. And you've begun to see this increased scrutiny, at least from the bond market, with the AI build out, both with how much they're spending, with circular deals, with vendor financing, and with the rise of open source models, particularly from China. So a lot has happened since we last recorded, and just looking forward to jumping into the conversation with y'all.
And thank you for that, Jordan. I just want to add that a lot has happened, and yet if you just looked at where the S&P was today for the first time since the end of May, it's not radically different. The S&P hit an all-time high on June 2nd, retraced modestly, not into correction mode by any means, but retraced modestly. And then we're recording this on August 13th. And last week, the S&P got to another new high for the first time since that June 2nd new high. So basically, the S&P has been treading water on the surface while all this other nonsense has been going on underneath. So Jordan gave us a laundry list. Billy, what struck you?
I think what struck me is the just pretty much massive rotation, as Jordan mentioned, kind of out of momentum into a lot that has not been working, so far this year. You've seen a pretty strong rebound in healthcare, medical devices in particular. You've seen a rebound in software. So a lot of those trades that were not working for the better part of essentially the past year have started to gain some traction. And that kind of goes to what you're talking about, John, is the S&P not going anywhere because tech momentum is kind of unraveled. But a significant part of the market has rallied. And that's what's kept the S&P flat while tech is kind of taking all the chin.
Ben, I want to toss it to you, but I want to do it in this way, if I may. So when we last convened, I brought us on air by saying that the market has sort of kicked us in the teeth, which it had. Beginning really last August through basically the end of May, not in a straight line, but we hit a couple of really major air pockets. And I want to illustrate that. I just made a note. This is not in any way indicative of portfolio performance or investment performance or anything else. I just want to highlight 3 holdings of ours: Intuit, Brown and Brown, and Microsoft. Intuit is forecast to grow earnings this year 18.4%. Brown and Brown is forecast to grow earnings this year 10.28%, and Microsoft is forecast to grow earnings this year 25.12%. Solid companies. They are repeat earnings growers like clockwork. That's why they're in our portfolios. Those are the types of companies we want to own. Yet, for various reasons, Ben, I hope I'm teeing you up for this. The market decided that we were subhuman species for owning these things. And from its peak, Intuit declined 61.5%, Brown and Brown declined 42.3%, and Microsoft declined 30.4%.
Mm-hmm.
Since the trough in those 3 stocks, Intuit is up 31.22%. Brown and Brown is up 27.4%, and Microsoft is up 39.6%. Now, I'm not taking a victory lap, but when companies do what they're supposed to do and the market ignores it, eventually smart investors recognize the value that they represent. Ben, do you want to build on that?
I feel like you really did a good job talking about a lot of that. I don't know how much there is to build, but I'll say this. I
New
think when
names, new
sometimes
opportunities.
you see price and earnings. Imagine a chart right now, and you're plotting earnings and price out. Those things should be correlated over time. They should both move for good companies from the bottom left of a chart to the top right of a chart. That means earnings is growing. That means price is growing. Sometimes you get what almost looks like an alligator mouth, right? And you get earnings continuing to go higher, and you get price moving lower. Sometimes that's the market sniffing something out, right? And it's not showing up in numbers yet. It's the market discounting something. And so that's kind of what happened with this trade, right? John, you mentioned Intuit, Microsoft, Brown and Brown, 3 very different businesses. Yeah, they were all folding underneath the pressure of AI. Brown and Brown, because you would never need an insurance broker again. Microsoft, because that's going to replace some of the need for office-related products. Plus, Copilot is not nearly as strong of a model as what's coming out of Anthropic or OpenAI. Therefore, Microsoft sucks, right? Intuit, nobody will ever use tax software again, because we're all just going to upload every single personal financial document that we have into Claude, who's now watermarking everything. It's just out there stealing everything from everybody. But yeah, we're going to upload everything into it and let it file taxes on our behalf, right? So all of those were folding under AI pressure. But at the end of the day, when you have earnings going in one direction and price going in the other, one of those things is going to be wrong, right? Either price is wrong or earnings is wrong, and earnings will eventually fall over. Now, it takes longer than just a quarter or 2, in my opinion, for that to be known, for that verdict to be passed soundly. And John, I think that's why you said we're not taking a victory lap yet, right? We're just pointing some of these things out. But so far, you're continuing to see really good earnings out of a lot of these companies, right? Not every single company, but out of a lot of these companies, you're continuing to see strong earnings. Out of a lot of software companies specifically, you're actually starting to see a lot of growth out of AI and AI-related things. And to me, that makes all the sense in the world, right? Software is the rails. That is the rails in which businesses work, right? That is the easiest place to plug AI in. It is so much harder to rip out systems entirely and put
AI in place. It is so much easier to layer AI on top of existing software, right? And so software companies have a natural head start on Anthropic, who's trying to build out software essentially into every single space. They want to be your software solution. Microsoft has a head start on them there. Intuit has a head start on them there. Right? That doesn't mean that it's going to work out well for all of these software companies. You got to continue to execute, right? But I think for now, we're seeing that the earnings are still good, and therefore you should expect price over time to revert back to that long-term correlation, right?
So I think that's well said. I want to take a slight variation and go back to when these names were falling precipitously. And basically, it was late August to early October of 2025, and then February of 2026, and we had another leg down in May of 2026. And I want to talk about something that, in my opinion, doesn't get as much press as it should. We have a lot of speculation going on in the marketplace today.
Oh my gosh, yes.
So much so that some really otherwise seemingly bright people decided to give a 24-year-old with zero investment experience how many billions of dollars to play with? And he was levered at 5-to-1, I believe, which means for every dollar that somebody gave him, he borrowed 5 more. And guess what? He bet against serial earnings compounders. He bet against software. Ben, before we came on air, you and Billy were having a back and forth, but you had a quote, or maybe it was you, Jordan. What is it that this clown at situational awareness said he's going to do to software?
So I want to put it on the record. This guy is way smarter than I could ever hope to be. Right? I mean, he's a genius. He is a genius. He just doesn't even begin to understand risk management. But he said we're going to sonic boom you when talking about software companies. That we're going to obliterate you. That software will just no longer even exist. That's such an extreme view of the world.
It really is. Guess what? We're all wrong often. We only have to be right one more time than we're wrong. But I mean, being wrong, there's no crime in being wrong. To me, where the fault lies is in when we're wrong, okay, we suffer the consequences. The stock we bought went down in value. When he was wrong, the consequences were way more dire because not only did the stock that he shorted go up in value, but he owed his creditors more than these stocks were worth. He had to liquidate a huge portion of his portfolio just to pay his creditors back. So when you are speculating using leverage, it really amplifies, and it can have an effect on the market. The effect on the market today of all the leveraged ETFs that are available to people trading on their Kalshi accounts is crazy. The amount of options that are being used today with single day expirations. In other words, you're just predicting where the stock is going to finish today. That is rampant speculation. Who wants to pick up that thread?
And the speculation is not just in the financial market either. I read some today, which you guys may have probably also read, where Gen Zers, a third of them are now counting sports betting, or maybe half of them are counting sports betting as their long-term financial planning strategy. It's and it was either
that's what I was going to mention. It's crazy.
Mixed up, but third or half of them that had earmarked investments to go into funds or ETFs or stocks, whatever it is, pulled them to then bet on games. And so the speculation is everywhere. Everything has become a one big gamble.
Yeah, and I think that we can actually sort of tie that back into markets, because Billy, one of the things that you talked about that has come back, right? Because we've had really good performance over June and July. We've had a nice summer here in Charleston, and And Billy, one of the things that you touched on was medical device companies, right? And we own a number of medical device companies: Abbott, Stryker, Steris, ResMed, right? We have exposure to that healthcare space. John, you sent me an article from the Wall Street Journal just this week where it talked about how healthcare shorts were funding AI longs, right? And so, no, Abbott Labs has nothing to do with AI, right? But if you're funding your bet that that Nvidia is going to take over the world, or that Lumentum or whoever it, right? It changes all the time. It's now optical. Jordan, is that right? It's now optical instead of DRAM, and it was DRAM. I mean, it constantly moves, right? But if you're funding those things, you sell the boring piece, right? That's why healthcare gets sold. And then we come up with reasons as to why healthcare is down, right? Well, healthcare is down because of this, that, or another. No, healthcare is just down because that thing is up. Investing dollars are somewhat finite. Now, we add to the investment market every 2 weeks or every month as people make 401k contributions or IRA contributions. So money gets added to it, right? But investment dollars are somewhat finite. So Abbott Labs gets sold because you're buying AI. And Billy, to me, that ties into that speculation as well, right? Because you're no longer selling Abbott Labs because you don't believe, you're not selling Abbott Labs because you believe it has a bad outlook. You're just selling it to go fund that other thing.
Yeah, there's no fundamental, like true fundamental underpinning to a lot of the, I would say, kind of the day-to-day trading. We talk about momentum, and typically when you talk about momentum, you're talking about the momentum that's going up. But all these names that you just mentioned, it was just momentum going down, and it has been one trade. The stocks that go up and the stocks that go down, and there's nothing in between, or there hasn't been anything in between. At some point this spring, probably in April, May, we were negatively correlated with the market.
Yeah. This summer we've been mostly
that
negatively
has
correlated.
that has never happened before. We're typically positively correlated with the market. We may not have the swings up or down, but we were negatively correlated with the market. That is an insane anomaly.
And that seems to have changed. That seems to have changed just, over the past 6 weeks, I would say, since or whenever situational awareness blew up. But we've talked at length really since last August, Billy, about that concept, right? About how correlations under the hood of the market felt like they broke down. And it goes directly to that article, Ben. People were just shorting baskets of stocks to fund longs. So you have this wild volatility under the surface. I mean, you can look at the VIX that is looking at each individual constituent, like an equal weight VIX, if you will. At the end of May and into early June, it was at the highest level it had been since the Liberation Day sell-off, while the market was at all-time highs. That didn't make a whole lot of sense. What you've seen since then, since situational blew up, is that equal weight VIX has come way down, volatility's come down, and it almost seems like things are beginning to somewhat make sense again. Right now, there's still days where chips are the only thing that's working and buoying the market, but it had gotten just so extreme. And once you sort of, situational awareness blew up, or just that momentum trade blew up and leverage came out of the market, then it's like, okay, this makes a lot of sense. These companies were just being indiscriminately sold to fund these long positions, and it's sort of a wash.
Can I jump in here just real quick and say that, I went on ChatGPT to ask if mean reversion still worked, and it assured me that it does. And so what that means to me is that, we had inverse correlations where this thing was getting sold because we just wanted to own more and more of this thing over here. I say we, meaning the average the investor public, not here at Tandem. So this thing that was getting sold became deeply discounted. We have pointed that out numerous times, that the basket of stocks that we like to live in is at the largest discount to fair value that any of us have ever seen, right? It's crazy. Now it's coming back. Why is it coming back? Because mean reversion works. And what we pay for something at the end of the day is what truly matters. I know I've used this reference before, but I think it bears repeating. 1 in 10 homeowners today are underwater in their mortgage. It's not a crisis. It's not a tragedy. That is nothing like 2008 and 2009. Nothing like it. But still, you walk into a room of 10 people and one of you in that room owes more on your mortgage than your home is worth. How does that happen? It happens because you paid too much for your house. Now, guess when most of these houses that are underwater were purchased? 2022, 2023, 2024. Why is that relevant? Because we were in a momentum driven real estate market. And if we waited to buy our home, it was only going to get more expensive. So let's go ahead and buy it now. And in the short run, what we pay for something doesn't matter. The momentum behind it is what matters. In the long run, what we pay for something actually matters. And we now find ourselves in a world where these things that are valuable businesses because they just grow like clockwork, but were deeply discounted, are now being recognized as a value place at a compelling price to pay. I'm not saying they're replacing what's hot, but I am saying that they're working. And that's why we have stocks in our portfolio that since they bottomed are up 20, 30, 40%, because that recognizes a deep discount. If you're chasing what is working today, it will probably work for you tomorrow and maybe next week and maybe even next month. But ultimately, what we pay for something matters.
Yeah, I think that's really well said. And John, I think that that dislocation that you were touching on, we took advantage of it, right? We came into this year with a very elevated cash level. I'd still say cash is fairly elevated right now in large cap core, for example. It's in the mid to high teens, around 17, 18% as we're doing this call. But we've added 12 new names to the portfolio in large cap core. That's the most since 2022. That's more than we got to add during COVID, right? But the market's at all-time highs and Tandem's sitting there putting cash to work. That's because our space is essentially in a bear market, right? It doesn't matter what the market is doing. We're market agnostic, right? We're looking at consistent growers, right? That space, durable compounders, has entered a bear market this year. And that is the space in which we invest. And so we've added 12 new names to the portfolio like it is some significant market drawdown, because it is in this space. Right. And I want to make one other point, because Jordan, you were talking about sort of market dynamics this year. And maybe Nikki's going to cut this part out. But when I was looking at our performance from August of last year through, I think, the end of July, there were two pockets that led to our underperformance. From mid-August, August 22nd to be exact, to October 29th of last year, the S&P 500 Low Volatility Index fell nearly 6%. High beta cyclical stocks were up about 10%. The S&P was up about 6 to 7% during that time frame. Guys, that's not getting an investment wrong. That's a factor rotation where we lost 12%, right, in terms of relative performance in about 8 weeks. In April and May of this year, following the March 30 announcement from President Trump that they were going to start trying to find a ceasefire in Iran, which I feel like we're still trying to find it in mid-August. But the initial announcement came out and markets ripped, chips ripped. In 6 weeks, chips were up like 70, 80%. Momentum was up 30%. The S&P was up like 15, 16, 17, 18%, something like that. Low vol was flat to down, right? We lost nearly 20% in relative performance in about 6 weeks. Not because we went and put it all in some company that blew up in our face, situational awareness style. That's not the case at all, right? We lost relative performance because of the style of investing that we have done for 35 years, right? Which is a less volatile, low beta investment style. And low beta got left in the dust over 2 6 to 8 week periods in the last year. And that accounts for more than 100% of our underperformance. I would imagine that if I was sitting in front of nearly any client out there and I said, hey, chips are up 80%, do you expect us to keep up? They'd say, no, right? That's not your market. And that's the truth, right? And if you remove those melt ups, where the things that never in 35 years have we ever touched, we're doing exactly what we have always done. That's all I got.
Way to go, Ben. I second that emotion. And I would just point out that, this isn't excuse making 101 here. This is just observing the market that we find ourselves in. And volatility creates opportunity. Volatility to the upside gives intelligent investors the opportunity to take something off the table. Volatility to the downside gives intelligent investors the opportunity to put money to work. We have done both. We ended up with a cash position in the mid 20s in large cap and mid cap core, and in the mid to high teens in our equity strategy. And now opportunities have presented themselves, and we are putting that capital back to work at compelling valuations. Not only were we able to add 12 names to the large cap core portfolio, but we were able to add to existing holdings within our portfolios, holdings that we had conviction in, even though they were down 30 or 40%. We viewed that, after we calmed down, as an opportunity to put capital back to work, right? That's what investing is. It is playing the long game. It is not trying to beat next week. It is putting capital to work when valuations are compelling, not chasing a story. Anything else to add there?
No, I think you both said it well.
Terrific. Then I want to conclude with just sort of an announcement / update. We have 3 legacy strategies called large cap core, mid cap core, and equity. Large cap core is our flagship. It dates back to 1991. It has a track record north of 35 years. We incepted equity in 2007 and mid cap in 2010. They are all seasoned. They've been around the block. We love all 3 of those strategies. But we have discovered that we can do something pretty neat and apply it in other ways. And that thing that is pretty neat, the thing that we've always done, is identified what we call tandem quality. Through identifying tandem quality, we've been able to add some new strategies. Ben, you've done most of the work on this stuff. Would you just take a minute or two to just sort of let our viewer listener know what these strategies are, what we hope to accomplish with them, and how it's not some new direction we're going in, but a logical extension of what we're doing?
Yeah, for sure. So tandem quality is a way to effectively measure how tandem-like a company is, right? Historically, our process continues to be today is very binary. You either meet our criteria or you don't, right? And so we look for consistency in earnings, sales, cash flow, and dividend growth during sort of economic period, right? So if you're growing 2% one year, 50% the next, hey, you're growing consistently. There's nothing consistent about that growth, but you're growing consistently. You meet our criteria. If you grow between 7 and 8% every single year, you're growing consistently and your growth is consistent, right? One is more tandem-like than the other, though they both meet our criteria. And so we went from, we realized not within our existing flagship strategies, this is outside of that we could effectively put companies on a scale to say how tandem-like they are. And with that, we had the ability to start pairing up how tandem-like it is with any investable universe that you could name. Momentum, cool. Let's put a tandem tilt on that, right? And so there comes tandem quality momentum, right? It's the exact same quality screening that we're looking at on the front side, the same values that we're looking at on the front side. It's just a different way to evaluate a company, right? Instead of mean reversion, you use momentum. And so that launched tandem quality momentum. We're seeding other strategies that are using that tandem quality score in similar manners. We also launched a strategy called low beta anchored growth, which takes our core SMA, low beta SMA, and surrounds it with more momentous, timely ETF pieces around it, right? So you have this low beta anchor within the portfolio, and then you have this growth piece around it, and one should zig when the other zags. They become very complementary. We launched low beta anchored income, which is very similar in notion to low beta anchored growth, but instead of matching it with timely, momentous equity ETFs. It's aimed more at generating additional income. Think of it more like a balanced strategy. And then we launched an asset allocation model, which takes the same valuation framework that we sort of use and applies it down into asset classes. Right. So that one doesn't have the tandem quality score, but it uses the idea of mean reversion and asset valuation to allocate across asset classes. And so we have a conservative ETF allocation model, a balanced ETF allocation model, and an aggressive ETF allocation model. And so we've launched all of these products, and they're not us changing anything that we do, right? Large cap core is the same thing that it's been for 35 years. But we realize that there's natural extensions to the way that we manage money. Anything that I'm leaving out, Jordan, Billy, John?
No. Guys, great conversation. Thank you all. That will conclude today's Tandem Talk. We hope you, viewer, listener, find it entertaining, useful, informative, or something, and worthy of sharing with someone else. Until next time, thank you very much.
Tandem Talk is hosted by John Carew, Billy Little, Ben Carew, and Jordan Watson. Tandem Talk is produced by Elaine Natoli, Ariel Davis, Charlotte Woodham, and Mackenzie Farrell. This podcast is available on Tandem's website, www.tandemadvisors.com. Tandem Talk is also available for streaming and download on Apple Podcasts, SoundCloud, Amazon Music, and Spotify. Tandem Investment Advisors Incorporated is an SEC-registered investment advisor. This podcast is for informational purposes only and shall not constitute or be considered financial, tax, or investment advice, or an offer to sell, or a solicitation of an offer to buy any product, service, or security. Tandem Investment Advisors Incorporated does not represent that the securities, products, or services discussed in this podcast are suitable for any particular investor. Indices are unmanaged and not available for direct investment. Views and opinions expressed herein are those of Tandem. Please consult your financial advisor before making any investment decisions. Past performance is no guarantee of future results. All past portfolio purchases and sales are available upon request. All performance figures, data points, charts, and graphs contained in this report are derived from publicly available sources believed to be reliable. Tandem makes no representation as to the accuracy of these numbers, nor should they be construed as any representation of past or future performance. This podcast was originally recorded in English. Tandem does not guarantee the accuracy, completeness, or reliability of any translated materials, and shall not be held responsible for any discrepancies, errors, or misinterpretations arising from the translation process.